What if the safe, highly diversified dividend ETF you're heavily relying on for your portfolio's stability is actually hiding a massive concentrated sector risk right under your nose?
Yeah. And what if the label dividend is suddenly meaning wildly different things depending on exactly which fund you buy?
Right. Welcome to another deep dive. Today, our mission is to really open the hood and examine the engine of a massively popular investment vehicle. You've probably heard of it, and honestly, there's a very good chance you hold it. We're talking about the iShares Core Dividend Growth ETF.
Universally known by its ticker, DGRO. And it is an absolute giant in the ETF space. I
Yeah.
mean, we are talking about tens of billions of dollars in assets under management.
Huge.
Right. But the actual mechanical rules of how it functions, like how it decides what stays and what goes, they're surprisingly misunderstood by the average investor who just, sees a solid yield and clicks buy.
Yeah, exactly. And to figure out exactly what is going on with DGRO right now, we've pulled together a phenomenal stack of sources for you. We're analyzing raw, real-time options and dividend data from Market Chameleon.
Which is fantastic data, by the way.
It really is. Plus, we have a highly forward-looking 2025 thematic research report from CFRA detailing a massive sector shakeup. We're breaking down a hard-hitting ETF portfolio blueprint review, and because we love the fine print, we've gone through the actual very dense BlackRock and iShares prospectus supplements.
Yeah, we translated all that institutional jargon so you don't have to.
But before we get into the weeds, we have a mandatory disclaimer. We need to be explicitly clear with you about this. All the information we are discussing today is for informational and educational purposes only, and this does not constitute financial, investment, or trading advice.
Right, we're just here to analyze the data, synthesize the research, and help you understand the mechanics, not to manage your personal portfolio.
Exactly. So here's my promise to you. By the end of this deep dive, you aren't just going to know what DGRO is on a surface level. You are going to fundamentally understand the recent dramatic structural changes that are actively shifting how this ETF will perform in 2026 and beyond. Okay, let's unpack this.
Let's start by laying the foundation. Because to understand where DGRO is going in a really volatile 2026 market, we first have to understand the incredibly strict, uncompromising rules it uses to pick its stocks today.
Right.
So this ETF is designed to track the Morningstar U.S. Dividend Growth Index. And the absolute first thing that jumps off the page from that ETF portfolio blueprint review is the cost of admission. DGRO charges a remarkably low 0.08% expense ratio.
Let's contextualize that for a second, because a 0.08% expense ratio means it costs you exactly $8 annually for every $10,000 you have invested.
Which is basically nothing.
Right. When you compare that to actively managed mutual funds that frequently charge like 1% or more, which would be $100 per 10,000, that expense drag over a decade is the difference between retiring comfortably or having to work an extra 3 years.
It is incredibly cheap to hold, yes. But, low fees don't automatically equate to a great fund. It's the methodology, the actual screening process, that dictates performance. DGRO doesn't just blindly buy any company that decides to declare a dividend.
No, not at all.
The primary rule is that it requires a company to have 5 consecutive years of dividend growth.
Which is a brilliant initial filter. I mean, 5 years proves that the dividend wasn't just a one-off pandemic boom decision.
Right, exactly.
It shows a baseline level of corporate commitment through at least a few mini economic cycles.
Precisely. But the index goes much deeper than that. It also requires positive consensus earnings forecasts.
Meaning what exactly?
Yeah. That means Wall Street analysts must be actively predicting that the company will generate positive net income over the next year. It can't be coasting on past glory. It has to be demonstrably profitable looking forward. And crucially, it requires a payout ratio of less than 75%.
Okay, let's pause and unpack that payout ratio because it is so vital to understand. That metric means the company is paying out less than 75% of its net earnings as dividends to you, the shareholder.
Which forces them to keep at least a quarter of their profits to reinvest back into the business.
Exactly. The underlying logic here is sustainability. Think about the mechanics. If a company makes $100 million in profit and they pay out $95 million in dividends...
We only have $5 million left.
Right. $5 million left to hire new talent, build new factories, acquire competitors. They are stagnating. Or worse, if their profits dip, they might have to actually borrow money at high interest rates just to maintain that dividend payment and keep shareholders happy.
That is a massive red flag.
Huge. By capping the payout ratio at 75%, DGRO mechanically screens out companies that are suffocating their own future growth to maintain an artificially high yield.
Furthermore, the index automatically excludes the top 10% of stocks by dividend yield across its entire screening universe, and it completely omits real estate investment trusts, or REITs.
You know, reading through these incredibly strict screening rules, it gave me a very specific image. DGRO's methodology is essentially acting like a highly disciplined bouncer at an incredibly exclusive club.
Oh, I like that. Walk us through that. How so?
Okay, picture a bouncer standing at the velvet rope with a clipboard. Someone walks up wearing a flashy, oversized suit, throwing around a ton of cash.
Right, the ultra-high yield stock.
Exactly, the top 10% of the universe. They look incredible on the surface,
Yeah.
but the bouncer knows that guy is fundamentally unstable. He's probably going to cause a scene, or worse, his credit card is going to bounce by midnight.
The classic yield trap.
100%. A company whose yield is only sky high because its stock price has completely collapsed due to terrible fundamentals. So the bouncer kicks the flashy, unstable characters to the curb. He only unclips the velvet rope for the reliable guests.
Ones with a proven track record.
Right. The ones with a multi-year track record of consistently paying their tabs without completely draining their corporate bank accounts to do it.
What's fascinating here is how we can take that concept and apply it to how they actually arrange the guests once they're inside the room. I'm talking about the weighting methodology. Most broad market ETFs, like a standard S&P 500 fund, use market cap weighting.
Okay.
In a corporate boardroom, that would mean your voting power is based entirely on your overall net worth. The biggest companies automatically get the biggest seats at the table. But DGRO uses a fundamental weighting approach. Your seat at the table is determined strictly by the actual cash you bring in.
Oh, interesting.
Yeah, it assigns weights based on the total dollar value of the dividend payments expected to be paid out.
Wait, so it doesn't matter if a company has $1 trillion market cap. If they only hand out a tiny sliver of cash to shareholders, they get a smaller weight than, like, a mid-sized company that is aggressively returning massive stacks of cash to its investors.
Exactly. It completely changes the center of gravity of the fund. This fundamental weighting ensures a highly balanced portfolio. Right now, it holds 407 different companies, heavily weighted in financials, healthcare, and technology.
Wow, 407.
And returning to the exclusion of REITs that you brought up earlier, this is a massive, tangible benefit for the everyday investor. Because REIT dividends are structurally required to pass through income, they're typically taxed at your ordinary income tax rate.
Which can be brutal.
Really brutal. So by kicking them out of the club, DGRO vastly improves the fund's tax efficiency for you, keeping more of your yield safe from the taxman.
Okay, so the mechanics are clear. We've established the strict rules of the index. The bouncer's doing his job flawlessly. But here's where the story we are tracking today gets incredibly dynamic. Because what happens when the underlying market goes crazy and the club management is suddenly forced to change the rules of the house?
That is exactly the reality we're in right now. There have been two major overlapping structural changes impacting DGRO that fundamentally alter what you own.
And we really can't treat these as isolated events. Let's look at the catalyst. This comes straight from the CFRA research report we analyzed. They detailed a massive event that took place in March 2025. It was the annual reconstitution of the largest U.S. dividend ETFs.
Right.
And it wasn't just a minor rebalancing. It was a violent sector shakeup.
It was a paradigm shift for dividend investors. The CFRA report notes that because of how the macroeconomic environment shifted throughout 2024, this March reconstitution created a huge, totally unprecedented divergence in sector exposures across the market.
Because historically,
If you bought a dividend ETF, they all kind of mirrored each other. You generally knew what you were getting. But post-March 2025, the CFRA data proves that dividend ETFs absolutely no longer behave uniformly.
yeah, the report highlighted this perfectly by showing how DGRO's peers reacted to their own rulebooks. Vanguard's major funds, VIG and VYM, suddenly leaned aggressively heavily into financials and healthcare.
Right.
Schwab's massively popular SCHD practically went rogue, becoming an outlier by sharply increasing its energy sector weight while slashing its exposure to financials. And DGRO was just sort of swept up into this new chaotic reality.
And you really have to understand the why behind this chaos. Because these ETFs follow rigid mechanistic rules, when stock valuations and yields shifted over the previous 12 months, these funds were forced to grab totally different buckets of stocks during their annual rebalance.
Makes sense.
The impact here is profound for you. You can no longer treat dividend ETFs as interchangeable puzzle pieces. Because their sector exposures have violently diverged, holding multiple dividend ETFs might not give you the safety of diversification you think you have.
It's created massive hidden risks.
Massive, but also new tactical opportunities, depending on which macroeconomic sectors actually perform well this year.
Which perfectly explains why index providers felt incredible pressure to tighten their internal risk controls. That chaotic sector divergence directly brings us to change number 2. I was digging through the Dense iShares prospectus supplement dated December 5, 2025.
Ah, yes.
Effective December 2025, DGRO's underlying index instituted a major rule change regarding concentration limits. They've always had a 3% cap rule to stop any single stock from completely dominating the fund. But they updated it so that the 3% cap now applies at the company level rather than the security level.
It sounds like semantics, but it is a highly nuanced and critical shift in risk management. It means the 3% hard limit now aggregates all share classes issued by a single corporate entity.
Okay, let's give a concrete example for that. A company like Alphabet, Google's parent company, has multiple classes of shares floating around GitOD and GoGL.
Right.
Under the old rules, could they theoretically sneak past the bouncer twice and take up 6% of the room just because their stock is split into 2 different tickers?
Theoretically, yes, depending on the index's exact interpretation at the time. The new rule explicitly shuts that door. And crucially, the prospectus also clarified that the weighting isn't just looking in the rearview mirror.
Yeah.
It is based on the dividend dollars expected to be paid out over the next 12 months.
It's a forward-looking approach combined with a very strict concentration limit. But, I really have to push back on the philosophy of this rule for a moment.
Okay, let's hear it.
Does this strict 3% company-level cap actually hurt the investor in the long run? We are living in an era where mega-cap tech monopolies completely drive the broader market returns. By artificially clipping the wings of a runaway stock the second it hits 3% of the portfolio, aren't we just punishing the winners?
That is the ultimate trade-off in portfolio construction, and frankly, your critique is validated by the data. Yes, capping holdings at 3% absolutely limits your upside when those massive tech monopolies go on a historic bull run.
Right.
We can look at the ETF portfolio blueprint review to prove your point. Historically, DGRO's maximum drawdown, meaning the largest single drop from peak to trough during a market crash, was 35.10%. Surprisingly, that was actually slightly worse than the S&P 500, which had a 33.70% max drawdown during the exact same period.
Wait, I need to stop you there because that feels totally counterintuitive. You would naturally assume a defensively minded dividend growth fund would act as a safer harbor during a crash. Why on earth did it fall slightly further than the broader, riskier market at its worst point?
It comes down to sector composition.
Yeah.
Because DGRO heavily screens for dividend yield and growth, it naturally tilts towards cyclical sectors like industrials and financials.
Okay.
When a massive system-wide recession hits, those specific physical economy sectors often take a harder, faster initial beating than software companies with insulated recurring revenue models. That cyclical tilt dragged the ETF down slightly faster during the absolute worst of the panic.
That makes a lot of sense.
But here's the flip side, and why that 3% cap exists. The strict enforcement of this change guarantees true structural diversification. By preventing a single corporate entity with multiple share classes from dominating the ETF, DGRO is essentially forcing you to buy an insurance policy against single company implosions.
Okay, but isn't true diversification sometimes just a polite financial euphemism for accepting lower overall returns? Like, if I'm investing for growth, am I paying a premium for insurance that I don't actually need in a bull market?
Insurance always feels like a drag on your returns right up until the moment your house catches on fire.
Fair point.
If one of those heavily weighted megacaps suddenly faces an antitrust breakup or an accounting scandal and collapses overnight, your portfolio isn't dragged into the abyss with it. DGRO purposefully sacrifices a little bit of the absolute peak upside during tech manias to protect the fundamental structural integrity of the entire fund across all market environments.
Okay, fair enough. It's the bouncer saying, I do not care how incredibly rich you are or how much cash you're throwing around, you still only get one table in this club. So we've thoroughly explored the mechanics and we understand the recent dramatic shakeups. We know about the violent sector divergence in March and the strict new capping rules from December. Let's look at the present. How do the numbers actually look right now as we navigate through 2026? What are the experts forecasting?
Well, the real-time granular data we pulled from Market Chameleon paints a very clear picture of DGRO's current footprint in the market.
And the scale is just staggering. As of right now, DGRO is sitting on a massive $37.1 billion market cap. The forward dividend yield is hovering at 1.90%.
Yep.
And looking slightly ahead, the next projected ex-dividend date is June 15th, 2026. Market Chameleon projects the payout for that specific quarter will be roughly 33 cents per share, well, 0.3311 per share to be exact.
Let's contextualize that projection because the sheer number is significant. If that 33-cent projection holds true, it represents a 6.5% year-over-year bump for that specific quarter compared to 2025.
Yeah. Which is massive when you think about purchasing power. A 6.5% bump isn't just a fun statistic for a spreadsheet. It proves that despite a macroeconomic environment heavily burdened by sticky inflation, the underlying companies inside DGRO possess the actual pricing power to not just maintain their dividends, but to aggressively accelerate their cash returns to you faster than inflation is eating away at your dollar.
They're outpacing it.
Yeah. The dividend growth engine is clearly still actively functioning.
It is functioning beautifully. But let's look at the broader analyst sentiment to get a complete picture here.
Mhm.
The ETF Portfolio Blueprint Review ultimately awarded DGRO a very solid 8.5 out of 10 rating. They showered praise on its methodological ability to avoid those yield traps we discussed earlier.
What? I hear a but.
But they didn't hold back on a pretty glaring critique. Over the last decade, DGRO has factually underperformed the S&P 500. It delivered an 11.7% compound annual growth rate.
Just to quickly clarify for anyone newer to the jargon, the compound annual growth rate, or key AGR, is basically a way to smooth out the bumpy ride of the stock market. It means that if you averaged it out, your money grew by roughly 11.7% every single year.
Exactly. And an 11.7% key AGR is incredibly strong in a vacuum. However, during that exact same 10-year period, the SPY, which tracks the S&P 500, delivered a 13.23% TAGR.
So DGRO lost to the broader market.
It did. And if you compound that with the short-term technical data from Market Chameleon, they recently noted a bearish crossover trend for DGRO.
Explain the mechanics of a bearish crossover for us. Why did that matter?
A bearish crossover is a technical indicator where a short-term moving average, typically the 20-day average price of the ETF, crosses below a longer-term average like the 50-day or 200-day line. It isn't magic. It's a visual representation of shifting market psychology. It suggests that recent short-term momentum is souring compared to the fund's historical baseline. This indicates a potential downward trend or a reversal in sentiment, often triggered by shifting interest rate fears among dividend seekers.
So what does this all mean? We have this highly rated ETF. It has practically zero fees. It has a phenomenal bouncer at the door screening for quality, and it's aggressively growing its dividend payouts by 6.5% a year. Yet it has historically lagged behind the broader market by quite a bit, and current technical indicators are flashing a bearish warning sign. Why isn't a fund this well-constructed winning outright?
If we connect this to the bigger picture, it all fundamentally comes down to market cycles and macroeconomic regimes. For the last decade, we have lived in a historically unique era, utterly dominated by mega-cap growth stocks. We saw tech behemoths expanding at all costs, fueled by 0% interest rates. Because DGRO has a natural, rule-based tilt toward quality and slightly toward value, and because of that strict 3% cap on individual companies, it was mathematically destined to lag during a period where a tiny handful of non-dividend-paying tech stocks dragged the entire capitalization-weighted S&P 500 violently upward.
So it wasn't that DGRO was failing. It was basically forced to swim upstream against the dominant macroeconomic current of the last decade.
Precisely. But here is where the 2026 forecast becomes absolutely critical. Analyst sentiment from both the forward-looking CFRA report and the ETF blueprint suggests that this macroeconomic current is finally, definitively shifting.
Really?
Yeah. As we move deeper into 2026, the narratives completely dominating the market are no longer about limitless tech growth. The narratives are about geopolitical tariffs, stubbornly sticky inflation, and massive volatile sector rotations.
Right. The golden era of just buy the top 5 tech stocks, close your eyes, and go to sleep might actually be ending.
And if that era is ending, the game changes. If the market finally broadens out beyond those few mega-cap stocks, If we see capital defensively flow back into healthcare, robust financials, and high-quality industrials with real physical assets, DGRO is perfectly positioned.
Because it already holds all of that.
Exactly.
Yeah.
Its defensively minded, highly profitable dividend growth strategy is primed to shine in an environment where reliable cash flow and actual profitability suddenly matter far more to investors than speculative distant growth.
Okay, let's quickly recap the incredible journey we've been on today. We learned that DGRO is absolutely not just a blind basket of high-yield stocks that you can set and forget. It is a meticulously weighted, newly reconstituted portfolio of 407 companies. It acts as a strict, uncompromising bouncer, ruthlessly kicking out the yield traps in heavily indebted companies, even if its rigid 3% company caps have historically restrained its growth against the high-flying, tech-heavy S&P 500.
And the reason you need to care about this right now is simple. In a 2026 market that is plagued by inflation fears and aggressive, unpredictable sector volatility, knowing exactly how your ETF fundamentally weights its stocks is paramount. It is the absolute difference between having true structural diversification and suffering from accidental, catastrophic concentration.
But as always, we don't want to just give you the answers. We want to leave you with something to think about.
Right. And this raises an important question based on everything we have covered regarding DGRO's methodology. We know the CFRA report highlighted that dividend ETFs are now wildly diverging in their sector makeup. So are you accidentally double-dipping in certain vulnerable sectors across your portfolio just because you bought multiple funds with the word dividend in the title?
That is a phenomenal question. Keep an eye on the door and make sure you know exactly who your bouncer is letting into the club. Thank you so much for joining us on this deep dive. We'll see you next time.